London's housing market is a hot topic. It's a subject that captures the attention of many, from first-time buyers to seasoned investors. The city's real estate landscape is as dynamic as its iconic skyline, constantly evolving and presenting new challenges and opportunities. It's known for its high prices. The cost of buying a home in London is often prohibitive, with prices soaring well above the national average. This has made the dream of owning a home in the capital a distant reality for many. This makes it hard for people to buy homes. Young professionals and growing families alike find themselves struggling to secure a place they can call their own. The competition is fierce and the options are often limited, leading to frustration and disappointment. Many factors influence these prices. From economic conditions to government policies, the housing market is shaped by a complex web of influences. Supply and demand, interest rates, and even global events can all play a role in determining the cost of property in London. We'll look at what might happen to London house prices by 2028. Predicting the future is always a challenge, but by examining current trends and expert forecasts, we can make educated guesses about where the market might be heading. We will delve into historical trends to see where prices might be heading. By understanding the past, we can gain insights into the future. Historical data provides a valuable perspective on how the market has evolved and what might lie ahead. Understanding the past can help us make educated guesses about the future. By looking at previous market cycles, economic conditions, and policy changes, we can identify patterns and trends that may repeat themselves. From economic growth to interest rates, we'll cover the key players. The health of the economy, the policies of the central bank, and the performance of the stock market all have a significant impact on the housing market. We'll also see how affordable London housing is for the average person. Affordability is a major concern, with many Londoners finding it increasingly difficult to keep up with rising prices. We'll explore the challenges faced by those trying to enter the market and the potential solutions that could make housing more accessible. Join us as we try to predict what's in store for London's housing market. We'll bring together experts, data, and real-life stories to paint a comprehensive picture of the future. Whether you're a buyer, seller, or simply interested in the market, this journey will provide valuable insights. Predicting the future is never easy. The housing market is influenced by countless variables, many of which are unpredictable. However, by analyzing the data and considering expert opinions, we can make informed predictions. However, by looking at the data, we can get a clearer picture. Data analysis allows us to identify trends, understand market dynamics, and make educated guesses about future developments. It's a powerful tool in the quest to understand the housing market. Let's explore the factors that will shape London's housing market in the coming years. From economic policies to demographic changes, we'll examine the key drivers that will influence the market. Join us on this journey to uncover the future of London's housing market. London house prices have been rising for decades. This upward trend has made it difficult for first-time buyers. The average house price in London is significantly higher than the rest of the UK. Several factors have contributed to this steady increase. Strong demand, limited supply, and a growing economy have all played a role. In the past, low interest rates made it cheaper to borrow money. This fueled demand and pushed prices higher. Government policies such as Help to Buy also had an impact. These schemes aim to make homeownership more accessible, but may have inadvertently increased demand and prices. Understanding these past trends is essential for forecasting the future. By analyzing historical data, we can identify patterns and potential drivers of future price movements. Inflation is a general rise in the price of goods and services. It affects everything from groceries to utilities and even the cost of entertainment. When inflation occurs, the purchasing power of your money decreases, meaning you get less for the same amount of money. When inflation is high, the value of money decreases. This devaluation means that each unit of currency buys fewer goods and services than it did before. Essentially, your money doesn't go as far as it used to. This means you need more money to buy the same things. Everyday items like food, clothing, and fuel become more expensive, putting a strain on household budgets. People may find themselves cutting back on non-essential purchases to make ends meet. House prices are affected by inflation. As the cost of living increases, so does the cost of buying a home. This is because the materials and labor required to build homes become more expensive. When the cost of building materials and labor rises, so do house prices. Builders and developers pass these increased costs onto buyers, making new homes more expensive. This can also affect the resale value of existing homes. Buyers need to factor in inflation when considering purchasing a property. They must consider not only the current price of the home, but also how inflation might affect their mortgage payments and overall affordability in the future. If house prices rise faster than wages, affordability becomes a problem. This can make it difficult for first-time buyers to enter the market and for existing homeowners to upgrade or move. People may struggle to keep up with mortgage payments. As the cost of living increases, so do the monthly expenses, leaving less disposable income to cover mortgage costs. This can lead to financial stress and even foreclosure in extreme cases. This can lead to a slowdown in the housing market. When people can't afford to buy homes, demand decreases, which can result in a surplus of unsold properties. This can have a ripple effect on the economy, affecting everything from construction jobs to real estate services. Governments and central banks try to control inflation. They implement various measures to keep inflation in check and ensure economic stability. They do this through interest rate adjustments and fiscal policies. By raising or lowering interest rates, central banks can influence borrowing and spending, which in turn affects inflation. These measures aim to keep inflation at a stable level and prevent it from spiraling out of control. A stable inflation rate helps maintain the purchasing power of money, ensuring that people can afford to buy homes and other essentials without facing constant price increases. Section 4. Economic growth and its relation to housing. Economic growth refers to an increase in the production of goods and services in a country. When the economy is strong, people tend to have more disposable income. This can lead to higher demand for housing. A robust economy often translates into job creation and higher wages. As people earn more, they may look to upgrade their living situations. However, rapid economic growth can also lead to inflation. This can make it more expensive to build homes, pushing up prices. Governments strive to find a balance between economic growth and stable housing costs. They may implement policies to encourage affordable housing construction. These policies might include tax breaks for developers or subsidies for first-time buyers. Section 5. Wealth versus income, a growing divide. Wealth and income are two different things. While they are often discussed together, they represent distinct financial concepts that impact people's lives in different ways. Income refers to the money earned from employment or investments. This includes salaries, wages, dividends, and interest from savings accounts. It is the flow of money that individuals receive on a regular basis, which they use to cover daily expenses and save for the future. Wealth, on the other hand, encompasses all assets, including property, savings, and investments. It represents the total value of everything a person owns, minus any debts. Wealth can be accumulated over time and passed down through generations, making it a key factor in long-term financial stability and security. The gap between the wealthy and everyone else has been widening in recent years. This growing divide is evident in many aspects of society, from housing and education to healthcare and employment opportunities. This means that a smaller percentage of the population holds a larger share of the total wealth. The top 1% of earners have seen their wealth grow exponentially, while the majority of people have experienced relatively stagnant or even declining financial situations. This wealth disparity can impact the housing market. As the wealthy invest in multiple properties, they drive up demand and prices, making it increasingly difficult for average families to afford homes. Wealthy individuals may invest in multiple properties, driving up demand and prices. This trend is particularly noticeable in major cities, where real estate is already at a premium. This can make it even harder for those with lower incomes to afford a home. The dream of homeownership becomes more elusive, leading to increased financial stress and instability for many families. Governments and policymakers are exploring ways to address this growing wealth gap. They recognize that without intervention, the divide will continue to widen, exacerbating social and economic inequalities. These efforts might include progressive taxation policies or programs aimed at increasing wealth among lower-income households. By implementing measures such as higher taxes on the wealthy, increased funding for education and job training, and affordable housing initiatives, governments hope to create a more equitable society. Financial education programs are also crucial in helping individuals understand how to manage their money, invest wisely, and build wealth over time. These initiatives can empower people to take control of their financial futures and reduce the wealth gap. Ultimately, addressing the growing divide between wealth and income requires a multifaceted approach. It involves not only policy changes, but also community engagement and education. By working together, we can strive towards a more balanced and fair economic landscape for all. Section 6. The interest rate effect. Interest rates play a crucial role in the housing market. When interest rates are low, borrowing money becomes cheaper. This makes it more attractive for people to take out mortgages. Lower interest rates can stimulate demand in the housing market, potentially leading to price increases. Conversely, when interest rates rise, borrowing becomes more expensive. This can dampen demand for housing, potentially causing prices to stabilize or even decrease. Central banks, such as the Bank of England, have a significant influence on interest rates. They adjust rates to manage inflation and support economic growth. Changes in interest rates can have a ripple effect throughout the economy, including the housing market.